Remember in early August when markets went into a tailspin and caused a widespread panic sell-off? Well, guess what? It's happened again, and this time it's even bigger. On September 3rd, US stocks was being sold in a spree after fresh data pointed to signs of a potential recession in the US. The worst performer by far was AI darling Nvidia. Other tech names obviously suffered a similar fate, and as expected, we saw Asian markets also doing the same thing. So where do we go from here? So the stock market, it's been hit by the biggest sell-off since August. What's the biggest difference between this episode and what happened just a month ago?
Well, it's kind of sort of similar, really. I mean, I think investors really need to take a step back. We're looking at a very, very thin slice of horizon, which really goes back to, I would say, COVID days. We've had a phenomenal run. If you remember, the headlines at the time for COVID was obviously lockdown. I mean, it seems a long time ago, but government intervention was key. How did they do that? The biggest thing really was injection of money into the financial markets to create stability. Stability of financial markets is absolutely key because it's the backbone of everything. Global trade, confidence, social stability, everything. So they needed to step in. And the unintended consequence of that, and this is quite key, is that a lot of that liquidity which was pumped in, was not picked up from the real economy, but it has to go somewhere.
Right.
And it did go into financial markets. So that really created a liquidity boom, I would say, from that. And liquidity takes a long time to see itself in the real economy. Some people would say between 6 to 9 months before it really impacts the real economy.
Wow, that's a delayed reaction.
That's a very, very, very delayed reaction. But at the time, the headlines, you remember, was we need to save the economy. We need to save the global trade and what have you. So there is a massive incentive for central banks, not just in the US, but all around the world, to keep injecting liquidity.
Yeah.
Because we didn't really know how that was going to happen. So obviously that was going to help the global economies. But the bulk of that money was actually flowing into financial markets.
Right.
So it's not a surprise that we suddenly saw a big surge in markets. If you remember meme stocks, everybody's getting involved and everybody's just thinking, my God, this is easy money.
Yeah.
So that in effect caused a massive buildup in confidence at the meantime. But the big question now was that, or is now, was there too much liquidity put into the system at the time? So, but anyway, what's done is done. The cat's out of the bag.
And the beans have been spilled.
Yeah, exactly. And we've had a phenomenal bull market.
Yeah, we have indeed. September is apparently the most volatile time for US stocks. So should investors then always be bracing themselves for every time September comes around?
Yeah, I don't have evidence of this, but, Labor Day weekend kind of marks the end of the summer.
Yes.
I think what generally happens is that a lot of financial participants really take a step back from the markets. They have a really long summer holiday, and it's just kind of like Labor Day weekend is here. Let's all get together. How's your performance been? It's been good. Okay, what are you going to do? You're going to lock in profits? You're going to ride the rally? Ask another guy, performance will be really bad. So what are you going to do? Are you going to really try and go short the market, go long? So then that creates a lot of volatility. So I think what it is people look and say, hey, the 9 months, if you've been long in the market, it's fantastic, right? It's been great. But is it time to lock profits? It's time to lock profits. And it probably is. So probably a combination of people saying, I want to go short, I want to lock profits, and it creates a lot of stuff. The headlines of these economic numbers become even more pronounced.
Yes.
And we are getting to a stage, maybe this year, where we've had a cycle of an ending of an interest rate cycle, where we've seen interest rates moving up for inflation reasons. But now it's just kind of like, hey, you know what? Inflation is very much under control. If you remember, the central bank's main task is to make sure that inflation is under control. The bottom line is that, we're now heading towards that 2.5% level.
Okay.
Now, why is that important? Because we just said that actually most central banks around the world have an inflation mandate.
Right.
And we're heading towards that 2%. So time to maybe loosen the grip on the economy.
Okay. What does that mean, though, when a central bank wants to loosen their grip on the economy?
Well, I mean, there's a couple of ways really is to inject even more liquidity
Okay.
into the system. But
Right.
the most obvious one would be to lower headline interest rates.
Mm.
So there's always a big question mark of, okay, so I think it's quite clear now the trajectory of interest rates is going down. Now, the big question mark is very much, are we going to see a 25 basis point cut or a 50 basis point cut? Now, if you remember what I said earlier on about injecting liquidity and interest rates,
Right.
it does take a while for that to translate into the real economy.
Got it.
So is 25 basis points conservative? And because, you want to do it in small increments, or do you do a big bang and just say, hey, you know what? Maybe the economy is looking a little bit shaky. If we sort of send a signal that we're going to be cutting rates by 50 basis points,
Yeah.
and we've got your back, that in effect gives confidence to not only consumers but corporations as well. Now, this is very important because corporations need to make a decision in terms of whether they invest into more capacity or less.
Yeah.
And if you invest more in capacity, you will need more people to work in your factories. So
And
that
more people to buy your product as well at the end
so
of the
that
day.
leads to employment numbers as well. So it's all very, very interrelated.
It
But
is.
I would just say if you want to take a step back, a sign of interest rate cuts is perhaps the central bank being slightly conservative and saying, hey, you know what, maybe the economy is weakening and we just give it a bit of a boost.
Right. What's the market reaction going to be once they do cut the rates?
I would say there's also another sort of big theme involved here, and it's called the carry trade. Now, in the simplistic terms, it means that you use one financial instrument, a currency which is weaker, and you borrow that at a low rate and you invest it into another asset class, whether it be in equities or another instrument which gives you a higher rate.
Right.
So then there's a carry of, the difference between a low cost and a high return.
Right.
So I think that has been something which has been building for a long, long time. And this is not something which has been created by financial markets. It's because of this massive economy called Japan,
Yes.
which has been, sort of...
It's a strange place economically right now.
Yeah, it's kind of like the reverse. Everyone's been
Yes.
talking about high inflation rates and trying to control that. And Japan has been, everybody's been there. We haven't really seen prices move up for a long, long time.
I mean, to our benefit, yes.
To our benefit,
Not
yeah.
necessarily to Japan's benefit.
Yeah. So, Japan has been in a deflationary environment for a long time. They've been really trying to get out of that.
Yeah.
And they're actually, in fact, trying to increase the rate of inflation, which is very opposite to what everyone else in the world is trying to do.
Yeah. So since we're in Japan now, let's explore Asia a little bit more, get to know the Asian markets a little bit better. Can investors looking to step away from what's happening in the US with all this chaos, can they start looking into Asian markets, or do we need to be more acute, say be sector specific, for example?
I think Asia is interesting because there's been a couple of markets which have done really, really well. And some people would just say, wow, it's been a stealth bull market. I mean, one only has to look at what's been happening in Malaysia in the last 9 months. A lot of people will be surprised that in Indonesia, the Jakarta Stock Exchange is actually at its all-time high.
Wow. That's a place we rarely look at.
Yeah, in rupiah terms. And when was the last time you read a headline about inflation, about Indonesia?
Yeah.
So it's quite interesting because I think all the action and focus has been on what we've discussed, tech stocks, US, what have you, and for the right reasons, because they're very, very liquid. You can actually invest hundreds of billions of dollars, in a split second in the US.
Yep.
But in Asia, what we're seeing is that, liquidity is not as strong. If you want to put a big position, it's going to be a bit more difficult. So if you're a global fund, you probably want to invest in something which is very liquid. And unfortunately or fortunately, it's been in the US. But I think now with what's happening with the US, people are beginning to look at diversification.
Right.
And Asia has not done anything wrong. It's done actually a lot of good things.
Yeah.
But it's just that headlines and trading activity and AI names all tend to lead you towards, hey, what's going on in NASDAQ?
So it's really a play on the attention economy almost.
I think so.
So the financial markets or economies have become a victim of the attention economy.
Very much so. So the big question now is, okay, so what other markets in Asia should we be looking at? I mentioned Malaysia, that's done very, very well. Actually, the Philippine market has also done very well.
Right.
Some great companies there. I think Asia now, or ASEAN even, is definitely worthwhile looking at because they're doing all the right things. Inflation is under control. I would say, employment growth has been good.
Yeah.
They're still exporting to the US, which is still arguably relatively strong.
Yeah.
We talked a little bit about some questions about the health of the US economy, but I would say that it's strong enough to suck in exports from this part of the world. So these companies are doing rather well.
If we shift our attention up north to, say, Japan, South Korea, we're looking at the Nikkei 225. On that day after the sell-off in the US, it was down more than 4%, deep in the red. South Korea's Kospi also fell more than 3%. I'm curious at this point, how tight is the correlation between what happens in the US and what happens in Asia in general? I mean, is it always the case where we can expect Asian markets to almost fall in lockstep with US markets?
Most people, when they look at Asian markets in the morning, will always look at what happened in the US.
Yes.
It's difficult to really separate that. Because whether you like it or not, it seems to be the US market seems to be the barometer of global confidence.
Yeah.
The US is the US, but it is a big part of most financial portfolios. That's the problem. There's always going to be a big sort of pull towards what's going on and how it affects Asia. But, there is another side to that. We touched a little bit about the so-called carry trade where people have been, I suppose, shorting the Japanese yen and going long on the US dollar. And so really another big play here has been a weakening Japanese yen has been really good for Japanese exporters.
Oh.
So that's the reason why the Nikkei has done extremely well, because if you look at some of the big companies in Japan, they tend to be exporters, some real household names,
Yes,
the car companies, electronic companies, makes the Japanese products a lot cheaper. So there's a play there that actually the revenue for a lot of these Japanese companies, when it gets translated from US dollars to Japan in local currency, will do very well. So that's been reflective of the Japanese market. So the Japan market has done extremely well. So we probably saw a little bit of reverse of that carry trade. Confidence in the tech stocks is quite related to what's happening in Japan. So that's the reason why actually Japan saw a much more magnified impact to, let's say, other parts of Asia.
Right. Let's focus on China because we know what's happening there, right? It's basically not doing so well as far as what we think well is.
Yeah.
Just some figures here I'm going to run by you. About $6.5 trillion has been wiped out from the market value of Chinese and Hong Kong stocks. So what should investors with Chinese stocks in their portfolio do now? How do we know it's time to exit and maybe even re-enter in the future?
4 years of real underperformance. Also coming from a period where the previous sort of 10 years where China was pretty much the darling of most, not Asian investors, but global investors as well. So we've really seen a big U-turn, not just in terms of sentiment. We talked about people wanting to invest in China, but it's become a career risk because a lot of people just say, hey, the headlines and sentiment are so negative. Why would you want to even look at China right now?
Yeah.
So in effect, that's actually driving even more people away to other parts of the world. So the positioning in Chinese stocks from a global point of view is obviously very, very low. Every time I read a headline, it's another property company going bust.
Yeah.
There's
defaulting.
There's defaulting, and there's governments being told to, directing local governments to buy more property to take the oversupply. So I get it. But, what we are seeing is, as painful as it is, we are seeing the right things happening in China.
Oh.
We are seeing a deleveraging of the economy. Debt levels were far too high. I think at the sort of peak of the market, there were obviously a lot of worries about the leverage, property leverage. Property became such a big part of the economy, and I think it was 30% at its peak.
Yes.
Now that's extremely high, which really meant that it was open to a lot of people spending or speculating too much money of their savings into property, so it became a risk. So I think the government really needed to take a step back from that and just say, look, enough is enough. So that's what the market participants were calling for, but there is no soft landing in an economy which is so big.
Yeah.
We need time. And China is big, and it will take time. So what you do have in your favor right now, if you do invest in China, which I'm beginning to look at, you're getting a situation where valuations now are extremely cheap, and you're not really seeing anyone overweight in China at all.
Yeah.
So as and when a sentiment does turn, and sentiment turns first, you could actually see quite a big move. Maybe the way to play it in China now is look for companies which have got good, strong cash generating assets, which is perhaps paying you a good yield. So you're essentially being paid to wait.
Right.
And position it that way, because there are some phenomenal good stocks in China. Some really, really good tech companies. I mean, obviously EV companies have done really, really well.
Yeah.
I mean, that's kind of been a different independent sector on its own. But outside of the EV sector, there are some really, really good companies.
We have to talk about Nvidia.
Yeah,
we can't not, all right? I mean, this is the AI darling.
Yeah.
The crown jewel in tech today. And for a while, all we ever heard was Nvidia this, Nvidia that, Nvidia the irreplaceable. So during the sell-off, $279 billion wiped out from its stock. Is this a sign that the AI bubble burst that everyone keeps speculating about, is this finally here?
I don't think so. I think, to really say that Nvidia is, a barometer of AI is, I mean, it's definitely a good and easy way to look at what's happening in AI, but it's not the only play in AI. And what's really been happening is that perhaps the converse of what we talked about in China, where, most people are very, very overweight in Nvidia now, not just institutions, but I would say retail as well.
Yes.
And I think here is quite interesting is that I think the leverage bets on Nvidia was also extremely high.
Yeah.
So, when you have a shock like that, you are probably going to see people who have borrowed even more money to invest in Nvidia need to get out ASAP. So there were probably a lot of margin calls at the time. You have to put it into perspective. Nvidia's done had an amazing run, not just this year, but even the year before. So to really just say, hey, is this the end of AI rally because we've seen a 10 or 15 or 20% fall in the stock price as of last week, I think you probably will have to say, look, we've had a phenomenal run. It's not unique to see stocks like that, which are still very much the darling, to see drawdowns like that, 20%, 30%. But the story is pretty much intact. It's just that short term, we probably ran ahead of ourselves a little bit. We've had results, I think the last 7 or 8 results, which were beating expectations every single time. And it's important to note that actually the recent results actually officially did beat expectations.
They did, yeah.
But there's always this kind of whisper number. Stock's done really, really well. We want it to be even better than the expectations of a better result. So people want more to keep the momentum going. The company hasn't changed in the last week or in the last month.
Yeah.
And I think
Jensen Huang hasn't changed his messaging at all. He's stayed consistent to his credit.
Yeah. So really, nothing's changed. Just the market perception or the market valuations have changed very rapidly, because that's the only thing that can change in the short term.
So clearly AI is here to stay. Investors will still find tech stocks appealing. But how can we remain invested in tech and AI stocks without letting all of those headlines affect the way we feel about our holdings in these companies, affecting our positions? Essentially, what should drive us tech investors to stay in tech?
The key thing is it's positioning in these stocks, because there's certainly great stocks in sort of the AI sector. What I mean by that is that don't over leverage on these things, whether you like it or not. Volatility increasing, because we are in an area which is unknown. I mean, if you ask 5 people what AI really means to them, you get 7 different answers. So it's a difficult one, right? So we can talk about, what does it really mean in terms of monetization? But I think, finding a stock which is really going to be at the center of that ecosystem of AI, and then sticking with it and positioning yourself for the long term. In other words, you're not going to be trading that stock. You're not going to be speculating on that. You like the theme, but more importantly, you like the company. The company is well run. And that's all we can really do as investors. And that's key. And you will see 15, 20% drawdowns, pretty sure. Maybe another few weeks, I'm not too sure. But, you have to be in a situation, you sit tight on that. And that's really where I think a lot of people get frustrated, because they over leverage. They buy on margin, or they buy stocks which have got perhaps business models which have got AI in a PowerPoint presentation.
AI for the sake of AI.
Yeah, AI for the sake of AI. So there will be a lot of these and don't get me wrong, there will be some companies which are going to do phenomenally well, which we're not talking about right now. And everyone will look for those companies for sure. But I think you have to really take a step back, look at your core positions in your portfolios. Make sure you're not too leveraged.
Yeah, I think patience as well to write it out. I think knowing what your values are as well as an investor, I think is what matters here a lot. So thank you for getting us started off and understanding how we can navigate the sea of chaos and mapping it all out for us. What financial advice would you give to your 20-year-old self?
Patience.
Just what we said earlier.
Yeah, it's really, really important, because I think most people at 20 would always want to look for the 10-bagger. I'm talking from my experience.
I was just about to ask, was there a moment in your investing career or life, personal life, that made you have this lesson, learn this lesson?
It's patience and really believing in a theme. We talked a little bit about, in the 90s, where the emerging markets were doing really, really well, and believing in that theme. And I think, sticking with that and having patience and riding that theme out. Things take a long time to develop. If there's a strong theme and you have conviction, really stick with that. So patience is really, really important.
Simple and a very important word.
And difficult to practice.
Thank you, Garett. It's been a pleasure. Listener, we hope you enjoyed this conversation and you have something to take away from this. As always, on the Money Talks podcast, if you have any thoughts or questions on this episode or anything else on the Money Talks podcast, feel free to give us a shout. You can email us. You can reach us on our apps as well, wherever you are listening to this podcast. Big thanks to the team, Junaini Johari, Crispina Robert, Tiffany Ang, Joanne Chan, Saya Wind, and Hanida Amin. I'm Andrea Heng, signing out.